looks like everybody's dropped in that's going to drop in. So we'll go ahead and get started here. So welcome to our first inaugural interview with an external party. We're very excited to have a special guest tonight. Unfortunately, our facilitator, Chelsea, is out of the office sick, so it's going to be a self-moderated event, but hopefully I can do Chelsea justice by doing a good job of that. So just briefly, I'm going to read a few words, a little light reading from our compliance department. The ideas, views, and forecasts expressed in this video or as of the date the video was recorded are subject to change without notice, may prove incorrect, and do not represent a recommendation or offer of any particular security, strategy, or investment. Telarray has no obligation to provide revised assessments in the event circumstances change. There is no guarantee that the strategies described will achieve stated goals. Investing is a fundamentally uncertain process, and Telarray cannot predict the future or guarantee any specific investment result. This material represents Telarray's intellectual property. This presentation may not be published, reproduced, transmitted, or rebroadcast in any form without express written permission of Telarray. Telarray may be contacted at letstalk@telarrayadvisors.com. All right, next we'll just have a couple of brief housekeeping announcements. If you would please, usually somewhere in the upper right, depending on what platform you're on, there's some sort of a button to full screen your video or make it larger or something like that. So that's definitely recommended in case there's any little numbers on there. Everybody's going to be muted, so you won't be able to actually speak out loud, but there is a Q&A box that you can use that I will monitor. I'll do my best to monitor and try to work in any questions that anybody has. If we can't get to a question, we'll definitely address that after the event. And we're really excited to get started. So without further ado, let me just briefly introduce our speaker. I have some words here. Apollo Lupescu is a vice president of Dimensional Fund Advisors, managing about $650 billion in assets. He is a nationally and internationally recognized speaker who has delivered hundreds of lectures and seminars to financial professionals and individual investors on various investment topics. Apollo is considered the secretary of explaining stuff because he has a knack for explaining complicated issues in a clear and understandable way. Apollo has been with Dimensional in Santa Monica for over 18 years, and prior to that, he taught at the University of California. He received his PhD in economics and finance from UC Santa Barbara. Apollo also holds a BA in economics from Michigan State University, where he competed and coached water polo. Rumor has it that even to this day, he is still learning, and most recently, he is not only getting in the pool, but also learning how to surf in the ocean. So there's Apollo there. Let me just make you a little bit bigger. So I've got to ask, I'm going to go off topic here a little bit, but I did a little bit of research, and I've got to ask you if you can tell us an interesting fact or two about being a White House interpreter.
Well, hi, first of all, thank you so much for the invitation to be here in this inaugural video. And, a couple of fun things is that by the time you see something happen, whether it's, it's the security, whatever it is, there's so much groundwork that was laid that is pretty boring and dull. And there's so much detail that's involved into those meetings that by the time you see that, like a few minutes of a handshake, there were weeks and weeks of planning. And even including, like, you look at the presidential route and the car that it takes. I mean, they're sweeping every trash can. They're looking at every single gutter. I mean, it is incredible the level of detail and preparation that goes into all these meetings. So
yeah, and the protocol, I mean, it's crazy. I've known people that work in protocol, and it's probably, you think investing stressful, I think that's probably one of the most stressful jobs in the world.
It is. And you got to stick with it. You can't miss anything.
Yeah.
The same as in investing in some ways.
Yeah. Well, I found that out. I found your dissertation, your PhD dissertation online, part of it. And I've got to say, that was an interesting fact. But the other interesting fact, I already thought you had the coolest name in the world, but then it seems your middle name is Dionysus. I mean, how did parents give you such an awesome name? I mean, that's people. Wow. I mean, that's awesome.
That is, you did some homework. Yeah. Well, yeah, the D stands for Dionysus in my middle name. And it's, part of my Greek heritage. My dad's side of the family was Greek. So I think he really wanted to have some Greek in it, and then eventually got carried away from Apollo Dionysus. So yeah, it's the Greek side of the family. But it is a super fun name. It's more memorable, but it's probably harder to go through high school with a name like this.
Yeah, no, I understand that. And just one last comment. This is only a preview, which I thought, I was like, wow, your dissertation is only 16 pages, but there are hundreds more. But I've got to say, I read the part that's here, and it's remarkable because I don't know if you've ever heard the joke that there's two types of economics papers. There's those that are unreadable after the first page, and those that are unreadable after the first sentence. And I would say this is the exact opposite. I was captivated. I mean, this is silly, but your discussion of the difference between, bootstrapping and historical, rolling periods, it's something hard. I mean, even back, this was 20 years ago, and you were already, I think, pretty good at explaining things. So I
Well,
thought that
thank
was
you.
amazing.
I had fun writing that. It was fun writing it. That's the beauty of anybody pursuing a high degree, is that you tend to work on something that interests you. Nobody tells you got to do this. There's no like homework to do. It's like, no, find something that really truly interests you and then go nuts on it. And that's what I love about the academic world, particularly once you get into the higher education. I think it's just phenomenally lucky to be able to do something like that.
Yeah, well, that's great. Well, that's all fascinating stuff, but I think probably not as many people care about you and me. They're more interested in the kind of work we do, So let's move on to what I wanted to talk about, and we talked about this just before we started, but I think we have an experience frequently where a new client comes in, or maybe even existing clients we've had for a while, and we talk about our investments, and we start talking about the providers we use, and we talk about Dimensional, and people say, not only are they unfamiliar with the way Dimensional's approach works, but they say, I'm not even sure I've heard of Dimensional. And there's all these sayings that it's the best kept secret, or the biggest and most successful investment firm you never heard of. I mean, it's 650 billion approximately firm. So what I really hope to do today was get you to kind of walk us through some of the history and some of the approach that they use. So I think that would be a good use of time, and something that it potentially can even be a resource for us in the future. So I think the first question I would really ask you, so you came on board, it says you've been there at least 18 plus years, but there's a lot of stuff that happened at Dimensional long before that. Obviously, it was a pretty mature firm even when you showed up. So maybe you could start with the impetus and the reasons for Dimensional's founding, and how it was different than the other firms at that time, and where it came from.
Yeah. So Dimensional, as you said, it is not a household name. I mean, most people outside of the profession don't really know Dimensional because we have not published ads, and we are one of the top managers in the country. But again, because we don't work directly with the retail public like all the other firms, we might not be a household name. But with that being said, Dimensional is a firm that is really well established beyond the assets. Dimensional got started back in 1981. So over 40 years of history and track record, for that matter, of these strategies. And the reason that Dimensional got started was because the founders of Dimensional went to school at the University of Chicago, which happens to be one of the most rigorous places to study economics and finance. And what they found is that there at the time there was a center that would collect data on the markets, which did not exist before, and there was a much more rigorous approach to understanding investments. And what they wanted to do is basically learn that. And as they did in their education, they went in the world, and what they found is that by and large, the world was still using something that wasn't exactly based on rigorous research, or at least the research that the academics were doing. So what they wanted to do is really understand, is there something beneficial in this academic, scientific, rigorous research that would be applicable in the real world? And they did find that there were studies out there that suggested that there are different groups of stocks that were not really covered very well in the market, particularly small companies. And what they decided to do is take those ideas and crucially try to implement them in the real world of investing. So when they did this, the first thing that they wanted is to have a group of academics oversee what they do. So they went back to Chicago and they asked a lot of the academics on the faculty, some of them at the time without a Nobel Prize, but subsequently actually being awarded one, to oversee what Dimensional did. And the idea was to take these very powerful economic and financial ideas from the scientific world in the practical world of investing. And the really important thing is that it's not just the idea, it's how you implement it. And a lot of thought was put in the early days on how to implement this. So as the company got started, based on this idea, let's just look and do something different that's not really done at the time, and let's do it based on the scientific approach. The early days, these funds were strictly available to institutional investors, the very large pension funds, the very large endowments, sovereign funds, and they were the only clients. And for the first 10 years of the firm, the only clients in the world who invested in dimensional funds were these very large institutions. And at the time, in about 1990 or so, a financial advisor came along and he said, I really like what your funds do, and they complement really well what else I do in my investment portfolios for my clients, and I'd like to invest some of my clients' money into these funds. And he was told, like, no, we actually only work with institutions. And this financial advisor was really intrigued. He's like, well, I'm offering you some assets, some money. Why don't you want to take them? And he understood that in order for these funds to operate properly, there has to be a level of institutional cash flow management. In other words, you cannot have hot money, people putting money in today and then a month later deciding that, I'm going to go move the money somewhere else, because it impacts everybody else invested in these commingled funds. So when he understood that, he came back to the leadership of Dimensional and suggested a way to work with the investing public and advisors that was very different than anything else done in the industry. What he suggested is like, okay, so perhaps there are other advisors just like me who are going to end up funding Dimensional, and they'd like to use the funds. And what we're going to do is actually restrict access to everybody. So no financial advisor can access the funds initially, and no retail investor, even more crucially, can access the funds directly. But as the advisors find Dimensional and they engage with Dimensional, they call and say, listen, I'd like to use the funds. There will be a process in place that could, at the time, would take 3 to 6 months of virtual and not just phone calls, in-person visits, attending conferences. And at the end of that process, it was more like a mutual due diligence process. The financial advisor would have access to these Dimensional funds for his or her clients. Yes.
Just a couple of follow-up questions. One is, well, just specifically to that end, do you think now that there are ETFs, is it just the creation and destruction of the ETF baskets allows for have a wider audience, or how do you bridge that?
So there are two different ways that you can create an investment fund, broadly speaking. There are multiple ways, but the most commonly used one is a mutual fund. And this is what Dimensional started initially. And a mutual fund basically takes money from various investors. And the role of the mutual fund is to take that money and buy certain securities, whether they're stocks or bonds, and put them into a particular fund. And the way that's done mechanically is that as the money comes in, you look at the end of the day and you look at the price of the underlying stocks in a fund, for example, and you figure out what is the value per share of each fund. And so a mutual fund only gets priced once a day at the end of the day. That's mechanically how mutual funds work. Now, along the way, somewhere in the 90s or 2000s, a different type of a strategy emerged. Not a strategy, a different type of investment solution emerged that's called a ETF, electronically traded fund, and ETF, and it's very similar in concept to the mutual fund. The difference is that when you buy these baskets of stocks in an ETF, instead of pricing them only once at the end of the day, you can price them throughout the day, and they trade pretty much like a stock. They have a ticker that they trades pretty much like a stock throughout the day, whereas a mutual fund, you can only trade at the end of the day. So ETFs came along, and ETFs have one additional benefit to, you have a mechanism in which as you create some of these shares of ownership in the ETF, you can delay some of these capital gains. So for example, if there's a stock that was bought at $10 and now it moved up at 12, in a mutual fund, you kind of have to realize that gain if you sell it, and you have to distribute that $2 gain, for example, to the investor. That's a gain that you've made. And if the stock was sold and you realize the gain, that's something that you have to pay in the year when that was realized. ETFs have figured out a mechanism in which you can delay that. Instead of paying it immediately, you can delay whenever you sell the ETF itself. So there are two different ways to package an investment fund. Think of it as, if you look at a Harry Potter book, you can have a paperback or you can have a hard copy. They're just different, but the content itself is pretty much the same if you want it to be the same. So ETFs and mutual funds are just two different versions of the ways that investments can be packaged. And whereas mutual funds can be restricted on a particular platform, that you can say, you know, if I don't want somebody at Schwab or Fidelity or whatever, the Ameritrade, whatever the platform might be, if you don't want that mutual fund to be bought, you can restrict that. You can't really do the same with ETFs. So in a way, we're not really looking to broaden the access to a different group of people. What we found is that because of that mechanism that allows you to delay the capital gains, some investors prefer that. Other prefers to pay along the way. And we had a set of tax managed funds, meaning that on top of the mutual fund that just deliver the performance, we're also seeking to mitigate some of the taxes that come with distributions or dividends. And these funds basically at some point realize that they can add another layer through a conversion to ETFs. So we took some of these funds, they were mutual funds, and we converted them to ETFs because there's a benefit to the end investor. But, you know, in that respect, those ETFs, you're absolutely correct. They couldn't be bought by anybody. Again, Dimensional is not a household name. This is much more about the advisors knowing and the advisors using them rather than the individual investors.
Yeah. Well, that's great. So just rolling back a little bit, I mean, one question is when you were launching this approach in the early 80s and into the 90s, why were you, I mean, this research has been coming out since the 60s and 70s, right? Why had nobody else done that? Was there just resistance in the financial community to an academic approach, or were there other hurdles? Why do you think Dimensional first? You know?
Yeah, so it's an interesting, because the founders of Dimensional basically were also the first people to ever create what we know today as index funds, S&P index funds. So they're very first to create these and go to large institutions and suggest to them, hey, let's use this research because it is powerful and it's indicating that these index funds apparently actually do better than the average manager. And there was a lot of pushback because the mentality at the time was different. The mentality was that, listen, you know, this is un-American not to try. And in fact, even today you hear a little bit that it's un-American not to try. You know, in the early days of Vanguard, which is an index company, you know, Boglegaard, the founder of these index funds at Vanguard, he got the same pushback. This is un-American. Like, why would you want to do this? We're not built as a country. So I think there was a mentality that was a bit of a relic, and it was hard to overcome. Secondly, the reason, in my opinion, is because there's a lot more money to be made into the funds that are traditionally managed, because the difference in fees between a dimensional or an index fund and some traditional funds that use the old way is tremendous. It's tremendous. And if you're a manager, what would you rather charge, 1% or 0.1%? I mean, you make 10 times more money into these traditional funds. So that was the second reason. And thirdly, you know, I'm not convinced that in the rest of the world, in the rest of our society, people have the information, but they act in the, you know, based on the data. I mean, to me, the clearest thing is that we've known for a while that smoking cannot be good for you. And yet you still see doctors and you see a lot of people still smoking, even as the evidence suggests that. And then probably the last thing that I would say is that the biggest reason that it was hard for people to come in and do what Dimensional did is because it's not just about the research. As you said, the research out there, you found my dissertation, the data and the papers on which Dimensional was built, they're in public domain. I think there is a very interesting thought here that is not just about the idea, but it's the execution that matters. And I become a firm believer that you can have all the ideas in the world. If you don't execute, it's not going to go anywhere. I mean, first of all, I live in LA. Everybody has an idea for a movie. Everybody has a script in their mind. I had scripts in my mind. I never sit down to write them down. Everybody has an idea. I know a friend of mine years ago who suggested, well, what if there was an app where you can, look at a car and you can call a neighbor's car? That was an idea. It never went anywhere because it wasn't executed. You have to execute the idea. Just having the idea is not enough. It's the execution. And in the case of Dimensional, because we had such an early start, we were able to build a scale that was really hard for others to overcome. Because by the time people realized there's really something to this, Dimensional had the knowledge, the know-how, and the scale to actually do it more efficiently, to do it smarter, and at a better value, a lower cost than others could. So, and then the track record to prove it. So then it became harder for some managers, but it's a combination of these factors that I mentioned.
Yeah, well, that's great. Well, let's actually take a step back into the ideas. So your Dimensional is definitely the first mover, and we can talk more about the execution, which I think you guys do a great job of in many levels. But what I'd like to have in your words, since you're so good at explaining things, we try this, and sometimes I think it resonates and sometimes it doesn't. But can you talk a little bit about, on one side, there's index funds, which is buying the entire market, and then there's active funds where somebody, depending on what side of the bed they woke up on, they pick, different stocks to buy and sell. But your approach, and what I really like, is a slogan I've heard before, that the idea of beating the market without outguessing the market is sort of maybe what this factor-based approach is that Dimensional uses. So maybe could you explain a little bit about that and how Dimensional actually looks at a market and actually builds a fund?
Yeah, and it's such an important question, because first of all, I find that the words that are being put out there, particularly active, passive, they're misleading. I mean, the word passive was probably invented by an active manager who wanted to make everybody else look great, because I don't want my wife to describe me as passive. So we got to be careful of the words. What do they mean? And I think you start laying out. Let's differentiate the different approaches that you have on your plate right now. These are choices that you have in terms of investment options. And the first one is, as you said, is this idea that if this square is the entire stock market, stock picking really is about identifying just the right stocks, buying just the right stocks, leaving out everything else, and adding value and trying to outperform because we pick just the right stocks. And this is what we think of as conventional, active management, traditional, whatever you want to call it. And the roots of this actually go back to Benjamin Graham, who was Warren Buffett's mentor. And he suggested that, if you're going to invest, it's probably not a bad idea to start looking at some valuations to get information about the company and research an individual stock. So in that respect, I do think that Benjamin Graham and Warren Buffett did absolutely, in a way, move the industry forward, because it wasn't just all about hunches, I've heard about this, but go ahead and have some ratio, some valuation, look at the company. And the system really relies on a key piece here in investing, which is information. And information can present a competitive advantage. And what I mean information are three things. Number one is, how quickly do you get the information relative to everybody else? If you can get information before other people, well, that certainly benefits you because you can move ahead of everybody else. Secondly is, what type of information? How good is the information? How comprehensive is the information? And thirdly, how do you process it? Do you know what to do with it to actually arrive at a good conclusion, a good decision? And to me, these three things are crucial for somebody who employs this type of investment management. And what's also very interesting is that these three things, in my view, have completely changed over the past few decades since Dimensional came around. And not because of Dimensional, but it just happened to coincide with that. And I think it's changed because there was an evolution in not just the investing, but in the world as a whole. So let's take the first question, information speed. How fast do you think it takes? How long do you think it takes today for information to get to investors? I mean, most people would say it's almost instant, like a nanosecond. It's very, very quickly.
And they
And
have
it's hard
microwave
to
towers, right, where they're blasting, data across the country, and it's wild.
Well, I'll give you Eugene, a really interesting one. Back the very first stock that ever traded in the world on a modern basis, pretty much the very first stock. I don't know if you happen to know, maybe it's like all the trivia for everybody. What was the very first stock traded exactly on modern basis, the same way that we trade stocks today, the same idea of ownership linked to profits and valuation and trading?
Was it Dutch East India Company?
You got it. The Dutch East India Company. Very good.
Yeah,
Exactly.
yeah.
So that was in 1602. So imagine back in those days, how long do you think it took for information to get to investors about a ship that got lost or pirates or whatever?
Months, right?
Months, exactly. And then it went to weeks, and then it went to days and hours. It was probably in the minutes about 100 years ago. It was probably in the seconds, maybe 50 years ago. And today, I think in that sense of the evolution, today, we are almost at instant. It's very, very quick. And it's hard to believe that anybody can consistently get faster information than everybody else. What about the level of information? I would argue that today, the information that is available to investor is monstrous. It's almost overwhelming. And again, I don't believe that anybody can consistently and legally get better information than everybody else. And the third one, it is about the analysis of the information. Boy, there are more funds managed professionally in the US than actual stocks trading on the market. It is incredibly competitive. And to suggest that, boy, somehow I can consistently outsmart, remember that for every buyer, there's a seller. For every Harvard PhD on one hand, you got a Stanford MBA on the other, and it's a tug of war. And to kind of say that I can consistently outsmart, it's really something that people have to be very careful in their judgment. And you can look at data, because ultimately it's about the data. What do you see in terms of these managers picking stocks? What do you see in terms of their performance relative to the yardstick, what we call benchmarks? And this is what we find. If you look at 10-year numbers, what you see is that after 10 years, if you backtrack about 10 years, about a third of these funds actually disappeared. And out of the ones that survived, only about fewer than 1 in 4 actually outperformed, meaning that 3 in 4 underperformed their benchmark. And if you look at 15 years, it gets worse. It's about 1 in 5. And 20 years, again, it doesn't get any better. More and more tend to disappear. So they don't even survive as a fund. And out of the ones that survive, only about fewer than 1 in 5 actually outperform. So the evidence right now, when you look at the data, is suggesting, because of this evolution that's taking place, that is intuitive to a great degree, because of this evolution, this way of investing, the stock picking, it doesn't appear to be state of the art. And what this academic, by the way, I'm talking a lot. So if you have any questions, please go ahead and interrupt. Don't let me.
No.
Sometimes I can get carried away with it.
This is great. So that's the reason that active management is probably more challenging than ever before, right?
Absolutely. And there are going to be some winners, because again, there's a buyer and a seller, but your odds as an investor are, you're going to pick, if you look at all the managers today, chances are that 5 and 6 are going to underperform. A lot of them are going to disappear. More than half over 10 years, they're not going to be there. So you got to be really careful with this particular strategy. And that's what the academic community, and this is what Dimensional also pioneered, which is a different way of doing research. And the idea being that instead of looking at individual companies, individual stocks, the idea is that let's consider these stocks, nothing wrong with them. So let's just absolutely consider them. But instead of trying to understand them by themselves, it was more useful to try to understand and capture the behavior of the entire basket of stocks to which these stocks might belong, and look at the entire group of stocks rather than individual companies. So in other words, don't love or hate any one stock, but rather look at that stock as part of a larger group, something that has become known as asset class investing. And there lies the difference, in my view, between the traditional stock picking, which sometimes is called active, but it's this idea of stock picking, which I believe it's no longer state of the art, versus the alternative, which is a research in understanding much bigger baskets of stocks. Now, this is not something that's easy for the individual investor. This is academics, this is large institutions, this is large fund companies who have the ability to collect the data and the computers to process so much information. So part of this evolution is basically it hasn't been as easy for individual investors to conduct the same level of research because it's at a different scale. In other words, it's like you're fishing by the rod, or now you have to fish by the net. But to fish by the net, you really have to have the more industrial size enterprise, and that's to me is like where things started to change in the early 80s from this conventional stock picking to more of an asset class approach. And then to me, that's a fundamental difference versus, for what Dimensional does versus what the conventional managers do. It's a type of research. We're still doing research, just that's different.
So just as an example, let's take a universe like international large cap, for example. So developed non-US large cap. It's not that your firm would pick a certain number of companies you think would be winners in that space, but really it's almost as though you would essentially take all of the large companies throughout the developed non-US world and actually have an allocation to essentially almost all of them, right? But the magic is that instead of it being based on the size, so the biggest company in that space would be the largest and so on, you actually adjust those weightings and those tilts to based on expectations of long-term outperformance, right, of that market. Is that accurate?
You're absolutely on the right track. And so let's unpack a little bit of what you just mentioned. So it all starts, and what sort of it's the secret sauce in a way, if you call it secret sauce. It's just really based on three different layers, if you want to talk about it that way. So the first layer is being able to understand the differences between groups of stocks. Because the same, like the analogy that I've always had in my mind is that, we talked about the fishing by the rod or fishing by the net. It's this idea that when you look at a school of fish, it's really hard to predict how each individual fish would move, left, right, upways, sideways. You can't really tell that, but you have a much better understanding of the school of fish. But now, if you look at the school of fish, the question is, how do you differentiate the different schools of fish? And it's the same with stocks. We know that not all stocks are the same. How do you distinguish between the different groups of stocks, between the different asset classes? And that has been a challenge for the academics and the practitioners since this idea of looking at larger baskets came around. And in the media, you quite often hear about sectors. There's technology, there's transportation, financials, utilities, you name all those. And in some ways, you can think of those delineations in the media as being more of I would say, a secondary characteristic, not a primary one, because you can really look in the data and see that the returns or the expected returns of one sector is different than the other, and there's an economic intuition and data to back it up. So because of that, we think of it as more like a secondary consideration. But the primary consideration started in the late 70s and early 80s when Dimensional began. And it was this idea that if you look at the stock market as this entire square, the first delineation was between the large companies. And this is what you typically see in the Dow Jones or the S&P 500, all these large, mature, well-established companies. But it turns out that in the US market, before even going to international markets, but in the US market, there are about 2,000 roughly other smaller companies that are still part of the market, but they are not in the S&P. And just to make it real, like I'll give you an example that is down the street from my house. I have not far from my house, I have a McDonald's, and then in Century City Mall, there is a Shake Shack. They're both burger joints. They both are publicly traded. But intuitively, you look at McDonald's and say, well, that's a mature company. It's well established, has a track record, management and so forth, resources. And on the other hand, you have Shake Shack, which hasn't reached the same level of maturity. On the other hand, you look at the growth potential, and it's easier to envision, for example, Shake Shack growing and doubling in size relative to McDonald's. So in that respect, economically, there is an understanding that smaller companies, they do have a distinct expected return from the larger ones because of economics. And the question is, does the data kind of back up that assertion? And there's a book that it's called the Matrix book. It's my kind of my favorite book in investing. It's a fantastic book of investing, and that one kind of gives us a bit of an idea of what the differences might be between large and small. If you look in the book, going back to the beginning of the series in the 1920s for the S&P 500, what you see is that one single dollar invested in the S&P would have grown to something in the order of a little bit over $14,000. That's a really nice growth for a $1 invested in the large company, a group of stocks. Now, the question is, if you had taken the same exact dollar and invested it in the small company index, this is a dimensional US small company index that is in the Matrix book, and you look at the growth of a dollar, exactly the same dollar, same time period, what you see is that the same dollar would have grown to roughly about $47,000. So there was the evidence that the smaller companies, they do tend to have a distinct expected returns from the large companies. And at that point, you can see that, hey, listen, if I am willing as an investor to pay attention to small company stocks, well, there seems to be a benefit there. And in fact, some of the very early funds were specifically designed to cover the small companies in the US, which at the time, they're not comprehensively covered by any other fund. So that's a little bit of the background of dimensional tied into this, but that's the very first dimension. There are multiple dimensions after this, but let me stop here. See any questions that pop to mind?
Yeah, well, there was, I saw a couple questions come in. We have so much to cover. We may have to answer some of those separately, but one question that did come up is, so what you're saying is, you use the term dimensions or premiums, and so small company is one. There's a lot of in the media and on message boards, there's a lot of people that are advocating this approach of one fund, fire and forget. And it's not even a target date fund. It's not even a core fund, but people say, just buy the S&P 500 or buy a total world market index. And I think we can demonstrate that that's probably not prudent. But for example, small company is one of the factors identified, one of the dimensions. So maybe you could just talk about diversification a little bit. If you can identify what you think is the best performing thing, why wouldn't you buy all that and nothing else?
Yeah, and in fact, you can take a layer further, because you're talking about, if you identify the highest performer, why not buy that? Well, it turns out that in the 80s, the question was, when you look at all these large company stocks, when you look at all the small company stocks, why, are they all the same? And the idea at the time was like, well, perhaps, there is something else. And what academics found is that what really matters is the valuation. In other words, how much are you paying to own a particular company? And in terms of the price of the stock relative to its book value, relative to earnings, relative to anything that is an accounting fundamental that can be measured objectively, and you look at the price, that's something that is really important. That's a valuation. The idea is, how much are you paying to own something? And the lower cost stocks, which are called value companies, what was interesting, it was noted that over the long run, they tend to outperform the more expensive counterparts called growth. So now, if you actually do pay attention to these asset classes, what you see is that an investment there would be not only value, because value outperforms growth over the long run, but if small beating large, what's the one asset class that ought to give investors the biggest bang for the buck over the long run?
Yeah,
pretty obvious, right?
Yeah,
it's small and value. And again, if you look at that, the Matrix book that I just referenced a second ago, the dimensional US small cap value index, same dollar, same time period, would have grown to about $134,000, roughly speaking. So what's interesting is that now, as an investor, you can look at it two ways. One way is they say, I might want to be diversified across the entire market, and I want to buy maybe some large and some small value growth. But then I can choose to emphasize and perhaps buy a little bit more small, buy a little bit more value, and that would increase the expected return that I would have in my portfolio. Or you can say, why not put all the money in small and value? To your point, it seems like this is given the biggest bang for the buck. Why not do that? So that's a very legitimate question. How come more people don't do this?
Yeah.
Where's the risk? What's the catch in this? And I think all of these are really important questions, and they kind of all have to do with the fact that this is almost like a system that's based on data and evidence. You look at the numbers, you look at the statistics, and that's what really drives this. Pretty much like medicine. Medicine is not a guarantee. I mean, even eating healthier, quitting smoking, working out, that's not going to guarantee you a longer lasting, healthier life. There are plenty of buses around. What it does, it just improves the odds. It just looks at the odds. And I think this is exactly what we're saying here. What we're suggesting is that small outperforms large and value outperforms growth. And one can say, great, well, I'm going to meet with you next quarter and I expect to see exactly that. And then that doesn't happen. And people feel a little bit disappointed. And they say, well, I'll come back at the end of the year. And that hasn't happened. And at that point, people are starting to look and say, well, perhaps this doesn't work very well. But here's the thing. This system is actually quite robust as long as you manage the expectations. When you look at value outperforming growth, what you see is that over a year, over an entire year, not a quarter, but over an entire year, roughly about 59% of the time, you will indeed see that value beats growth, which is exactly what I expect to happen. But it doesn't happen every single year. In fact, roughly 4 in 10 years, you will be disappointed. And that's the issue here. A lot of folks just don't have the discipline to stick around and understand that this is part of the strategy. And this is where advisors become so crucial to this process. And if you give the system time, what you find is that, let's say over 5 years, your odds improve. And 5 years is not a super long time horizon for an investment, but even if you look at 5 years, what you see is that, over 70% of the time, value will outperform growth. But it's possible that you run through a 5-year period, and that's going to be about 30% of the time. 1 in 3, it's going to be that growth will outperform, and you will be disappointed. But the question is this, Eugene, if you saw these odds, you look at the 5-year numbers, over 5 years, 70% of the time, value beats growth. Which part of the market would you like to emphasize?
We have maintained a value here at Telarray through the good times and the bad times. So we definitely would pick value.
Exactly.
It's mostly been good times. It's mostly been good.
Exactly right. Mostly are good times. But the question is, if you run this 5-year rough patch, that's not that unusual. That's not that unusual. And even if you give it 10 years, what you see is that even the odds improve, but even after 10 years, 1 in 5 periods, it won't be there for you. So you got to be careful, because all these premiums are really based on just understanding the statistics, and they're not in any way guaranteed even after 10 years. So that's why you have to understand your odds. And because of that, what I see a lot of people doing is saying, okay, well, I got to get it. It might not happen every year. And because of that, you want to have a bit of a balance. You want to have some large, some growth, but it's almost like, think of an ice cube trade that if that's the stock market as a whole, large, small, everything. And if you buy the market as a whole, it's like a leveled ice cube trade that all the cubes have the right amount of water. What we're saying is that if you actually tilt this, you take away a little bit of the money that might go in large growth and you distribute down to small value, but you're not doing this. That's kind of the idea. And so, because there'll be a lot of periods when you will be disappointed, but that doesn't mean that small value doesn't have the highest expected returns. It's just that navigating to get to that might be choppy.
One of my big disappointments is it's really unfortunate that the terms value and growth were picked for those things, because I think when an average person is going down their 401k and they say value, well, that sounds pretty good. But then they see growth and they say, well, yeah, I really like to have some growth. So they allocate to that. It's almost, I wonder if even these opportunities would persist as much if instead they were called cheap and expensive, or
Yeah,
low future expected
yeah,
return versus high future expected return. It's
you're
funny,
right.
but maybe your academic buddies can straighten that out for us. Rename it.
It's more like a marketing, because I think a lot of these, I mean, the folks on the other side who are trying to sell funds, they're doing a better job, I think, marketing some of these terms. And as you said, even active passive or value growth. I mean, we
Yeah.
invented these.
Yeah. So I think it's interesting, something you mentioned, it's kind of just like the dimensions or the premiums or the factors. One thing that we've always insisted on, broad geographic diversification here at Telarray, and have an extensive allocation to international and emerging. And that's been a little unpopular, but I think it's one of those things that sort of like a rubber band stretching, there's going to be some reversion to the mean there. And, I think you would probably agree that international is an important part of diversification as well.
Absolutely. And let's just dwell on a little point, because it's a really important point. The same way that times value underperforms growth and so forth, you have these different ways that you look at the world. And sometimes the US does better than the rest of the world. And people are questioning, why should I need the rest of the world when I can just buy these great American companies? They're selling abroad anyway. And to me, let me start by kind of putting a bit of a visual in everybody's mind, is that when you look at investing, it's about the opportunity. It's about looking at companies. And there are all these different companies around the world, and the US certainly has a big portion of them. And what I mean by companies, Telarray, I cannot really buy ownership in it because it belongs to some private owners. I can't really go buy ownership in my local bagel shop because it belongs to, my friends who own it. But on the other hand, I can buy ownership in Apple, Google, Facebook, you name it, all these companies, because they are public. They've opened up the ownership to the public at large, and I can go buy ownership in those companies. So when you look at all these companies that have opened up their ownership to the public at large by country, and you draw a world map where instead of landmass, you were to plot the value of all companies that can be bought and sold around the world, this is what that map will look like. The US has about 60% of the value of all companies around the world. There are roughly about 4,000 different companies that have opened up their ownership in the US. Around the world, you basically have about 40% of the value of all these companies, and there are roughly about 10,000 plus companies around the world in which you can invest. So a tremendous number of companies that you can invest around the world. And I want to maybe change a little bit the mindset that we're not really investing in countries. That's a little bit different the way that I look at it. We're not really investing in countries. I want you to think that we're investing in companies. And in that respect, if you look at the US, we certainly, should consider investing in GM, Ford, Tesla. They're all great American companies. And yet when you look on the street, I mean, look at your own neighborhood. What you see is that, yes, there'll be some Ford and GMs, but, you might also see some German cars. There's some Beamers and some Mercedes and VWs. And even great American brands like, Jeep and Chrysler and Dodge. They are not traded in the US. They're owned by a company, Stellantis, that trades in Milan, in Italy. You have the Japanese companies. We're very familiar with those. Even brands like Land Rover and Jaguar, they're owned by an Indian company. Volvo, owned by Geely, and then you have the Korean companies as well. So in other words, when you think about investing globally, it's not just about what we sell to foreigners, but also what foreigners sell to us. It's about the companies that we might know as all American, like Budweiser or Chrysler or Jeep. They're actually traded abroad. So in order to participate in those companies, you have to be globally allocated. And that to me is really a crucial theme here, is that you have to look and say, this is something that we need to pay attention to, not just the US, but globally. And there'll be times when the companies that happen to trade in the US, they do well. And the reason that people have mentioned that, Eugene, is because if you look at the 2010 to 2020 decade, the US is the yellow line here. It was the second best performing stock market over that decade. Not the best. New Zealand happened to be the best. And that's when a lot of folks start, wondering, well, why not put more money in the US? It's the recency bias, because recently the US has done well. Well, you and I have been through this. We've been in the industry for a long time, and we know that if you just look back one decade before, this is where the US was. Not on the top, it was very, very bottom. And this is where a lot of folks, not the very bottom, there are 3 other countries who underperform it, Greece being one of them. But that's the reason, in my view, why people should be diversified. It's not consistent. It's not that every decade the US is on top. And in fact, if you're going to look back, we have good data in the MSCI index going back to the 1970s. And if you look at the last decade, 2010 to 2020, you see that indeed the US on an annualized basis has outperformed the international companies that might trade somewhere else. Yet in the 70s, it was exactly the opposite. For a whole decade, international stocks significantly outperformed the US. 1980s, the same exact story. Significant outperformance of international developed relative to the US. And then the 90s, we had the tech boom when the US outperformed for a decade, but that was followed by what's known as the lost decade, where for 10 years, the S&P had an annualized negative return. So when you look at this, I don't see consistently US outperforming. What I see is there are times when they do, particularly you saw the technology stocks do so well in the 90s and also over the last decade. And in those times, yeah, it feels great. And the US is still a big portion of somebody's allocation. It's just that nothing in the data or the intuition screams at me that we should give up, that the US is the only opportunity place in the world. Not at all.
Yeah, I don't want to cut you off, but we're getting a little low on time. So I just wanted to, one thing that I got from those slides is that one of the nice things I think about a firm like Dimensional's approach is that you're not trying to guess what the Fed's going to do next week or things like that. But the US dollar has been so strong, and that's buoyed the US stock market returns in a relative sense recently. But I think if that trend ever does reverse, and I think it's likely to at some point, having that diversification in other non-dollar based assets, I think could be a really important thing.
Absolutely.
So we do have a couple other questions, really 2 main ones. So maybe I could get your 2-minute take on these next 2. One is there's a couple questions. How does this approach do compared to the S&P 500? And then somebody else said, when you say outperform, what do you really even mean? Are you talking about compared to the S&P 500 or something else? And I think the answer is against a market cap approach in that asset class. But of course, I'll let you address that.
Yeah, no. So those are really important questions. So the first thing that you should consider is that when you're looking at performance, what you should compare is basically apples to apples. So if you are looking at a fund that is based on large companies, you have to find yourself a benchmark, a yardstick that is appropriate for the large company. So in my view, if you look at that for the large companies, you should either look at the S&P 500 or you should look at another one called the Russell 1000, which are basically 2 ways of looking at the large companies. Now, if you're going to try to compare a small company fund with large company, that's not really fair because that they're distinct asset classes. So for small companies, probably the one that you ought to look at is it's another metric called the Russell 2000. So Russell draws the line after the first 1,000 companies, and those are large, and then the rest 2,000 are small. So in terms of yardsticks, those are the 2. So when you compare a fund, you should compare specifically to large, small, but then you can even do finer, small value, small growth, large growth. There are different benchmarks for each. So when I talk about, outperformance, outperformance here is not really the way that I look at it. I look at it as that smaller companies and value stocks, they tend to have a higher expected return relative to their larger counterparts relative to growth. So I see that. If you want to call that outperformance, we call that premium, which is the difference in returns between large and small value and growth. And the third dimension, which has to do with the profitability of companies, that we haven't even gotten into that. So the first thing is that you should compare apples to apples. Secondly, if you do want to outperform and say, my goal is to outperform the S&P 500, well, you can do that, over the long run by really emphasizing, as I said, small companies and value, not putting all the money in the large companies, but really kind of putting some into small and maybe emphasizing value more. And historically, what you've seen that in the data is that these two dimensions, they do give a higher expected return over the long run. So if you want to use the word outperformance instead of higher expected return, I mean, that's just certainly an option.
Yeah, well, that's great. Great lead into the one of the last questions, which we talked about the small cap dimension is your terms or factor. We talked about value. You mentioned profitability. I was just curious, you've been launching some profitability funds. There's some new funds in the emerging world you've launched. I mean, what sort of research are you looking at now in the very early stages? Is there anything on the horizon that might come out as a dimensional offering in the future?
So I think the big one that has been coming along for the past few years has been this idea of profitability. That you look at companies and you want to really understand the dynamic of profitability, and what it basically means is that at a very intuitive high level is that companies that are profitable, they tend to continue to stay profitable. Let's say over the next 7 years. The companies that are unprofitable, they tend to stay unprofitable. And in the data, what it shows is that these lower profitability companies, they do tend to have a lower expected return. So if you want to, increase your expected returns, then you would focus more on the high profitability companies. And so in that respect, it's almost like if you think of an elevator, it's basically you have multiple things that can pull up the portfolio that you can adjust. You have, instead of one cable being just small company versus large, or the second cable, which is value versus growth, you have a third cable that if one doesn't work out, let's say value doesn't work out with growth, well, you have two more. Where in the past you only had one more. So it just increases the consistency, but they're not really stackable to say that you get small plus value plus high profitability. It's more like you have more things to rely on, more dimensions to rely on. And if one doesn't work out, you got the other two. Then the funds that we create right now, I think that the big shift has been to take some of these ideas and perhaps not necessarily expand in terms of new ideas, but in the ways that they're implemented. So when you look at the implementation, we've had a set of sustainability funds, and right now what we're hearing advisors are saying is that there is a preference that clients have towards the same format in other the same idea in other formats, not necessarily just mutual funds. We've also had a big innovation lately with the separately managed accounts, where people want to put in more preferences. So I guess what I'm saying is that it's not right now, it's not necessarily about a next great big idea, but rather further refining the implementation, either through different formats for the investment solutions, or introducing the separately managed account, which is a much more customizable way that an advisor can work with a client to build an allocation.
That's great. That's great. So we're wrapping up on time here. Just a couple more. Well, a couple of silly ones. Are you and Apollo long lost brothers? I don't think so. No. Do you go to the same barber? I have sort of a self-care program. I'm not sure about you. So I think neither one of us probably spend too much time at the barbershop. But
once a week. Yeah.
Yeah, I think this is a good way to end. I was going to answer this, but somebody asked, we should have, I guess, established this in the beginning, but does Telarray have a relationship with dimensional funds? And I could answer that, but I heard that you have a really good stock answer to that. Is that something?
Well, I mean, we have a relationship in the sense that we have an alignment in the way that we look at the investment world in terms of the institutional approach, the very sophisticated data approach. What we don't have is a monetary financial agreement. In other words, we don't exchange any money. Eugene uses the funds and Telarray uses the funds because they think that out of the 3,000 plus mutual funds and ETFs and so forth, these are the right ones, but they receive no compensation from Dimensional because they use those funds. So it's completely exclusively working in your benefit. And if tomorrow they find that, hey, perhaps there's another fund family that does a better job, it's almost their obligation to use those funds, and they would switch you because, again, there's no, the only alignment here is not financial. It's really in terms of the investment philosophy.
Yeah. Yeah. So that's, and just to add on top of that, yeah, I mean, we've used dimensional funds here at Telarray since our inception, and we continue to today. So I guess that vetting process where we were allowed on the platform was effective because we certainly, and I think that's the biggest misconception that new prospects and clients have, is that it's our role to make big changes all the time and pick what's going to be the best thing over the next 6 months and jump around from manager to manager and approach to approach. And really, you know, I think the evidence indicates that's exactly the wrong approach, which we're very happy to have a long relationship with Dimensional, and it's a very important part of what we do here at Telarray.
Yeah.
So,
and I cannot, I mean, we cannot thank you enough, not just for the trust, the partnership, but the reality is that the reason that we don't work with an individual, just to be very candid, is that I cannot ever recommend anybody a fund. I cannot say buy or don't buy an S&P index fund. I can't say any of that, because the only way to know if that's appropriate for you is to have some sort of a financial plan, to really understand your circumstances, your risk capacity, what other assets you have. And all of these are things that you need to discuss with an advisor. And that's why we can never say buy one fund or the other. It always has to be the advisor who sits down and really truly understands what he's trying to accomplish with your money. And that's why it's impossible to say, should you buy an S&P fund or not? I have no idea if you should do that. Some of you might never have to touch the stock market, and all of you, maybe some of you might need to be in it. I just don't know. Nobody knows, outside of the advisor talking to you.
yeah, and we have our observatory process here. And what I always like to say is, you know, the investments are necessary but not sufficient. You know, if you use a sports analogy, I don't usually like those, but some people think the investment portfolio is like the head coach or the quarterback. But really, you know, to me, we're like the strength and conditioning coach on the investment team. Like, you have to have it to win, but really the client and the advisor are the head coach and the quarterback that are actually making the plays and making the decisions that really matter. And, you know, we put so much effort into making the best portfolio possible, but, you know, picking up a couple of 100 basis points here and there is not going to matter if, you know, the plan that you have is not going to work out. So this was really great. I think we got to most of the questions. If there's any other ones, we'll address those separately, but we want to be respectful of time. But Apollo, can't thank you enough for being on here. I think this went really well. And I think, like I said, I look forward to this being a resource that we can point to in the future to help understand our relationship and what Dimensional does and the approach that you have. So thank you very much. Is there anything I should have asked you that I haven't, or did we cover a lot of good ground there?
You know, how often do I get hurt surfing? I'm just kidding.
Oh, surfing. Yeah.
No,
Yeah,
it's all good. No, it's been a great fun talking to you. I really enjoyed it. So thank you for having us.
Great. Thank you. Well, thanks again to all the attendees as well. We really appreciate it. And we're going to sign off here, but we'll look forward to talking to Dimensional and others in the future. So thank you very much.
Bye-bye.
Okay.